Hello guys, welcome to my channel. If you are new to this channel, my name is Aziz. In this video, I'm going to bring you to the beginner guide to forex trading, and I have made sure to simplify everything in a way that even if you are a beginner to forex trading, or this is the first time you are hearing about forex and you want to learn and start your journey, I've made sure to simplify everything in a way for you that is easy for you to start your journey. So let's get into the video. So the things we are going to be talking about in this video is going to be the meaning of forex trading, currency pairs, time frame, trade sections, lot size, Pip calculation, take profit and stop loss. We are going to talk about Forex Broker, and we are going to talk about their spread, how you can calculate your spread also. We are going to talk about leverage, how to start trading even with your phone. We're going to talk about types of traders, where you can choose the kind of traders that you can be in order to accommodate that to your lifestyle or if you have a job. And also in conclusion, I'm going to give you my own perspective on how you can start trading and what are the things you should look into when you want to become a forex trader. So what is the meaning of forex trading? Forex trading is the buying and selling of global currency. It's how individuals, businesses, central banks and government pay for goods and services in other currency. Basically what this means is that when a business they want to buy goods or natural resources from other countries, they need to engage in trading of forex in order to allow them to be able to use their own local currency to trade in that country. By doing that, they're actually trading forex. This is also same for central banks or government when they have things that they want to buy from other country in order to enhance their country. They actually need to trade the forex market in order to be able to achieve their objective. This is also same for we individuals. When we want to travel to another country, we have to make sure that we use our own local currency to buy the currency of the country we are going in order to allow us to be able to spend and do things within that country. But for we forex trader, our objective is different. We are not trying to go anywhere or anything. Basically what we are trying to do is we are trying to look for price fluctuation. We are trying to predict where are we going to buy between these two currency. The difference is what we are trying to make money from. So in other words, I'm going to go into more details for you. But in short, you just have to understand that forex trading, the goal is basically trading one currency to another. And while we are buying one currency, we are actually selling the other currency. Now talking about currency pair. A forex pair is a combination of two currencies that are traded against each other. Example of this is the euro versus the US dollar. So what we are actually doing is that whenever we have the euro USD, we're actually selling it to buy the US dollar, and whenever we have the US dollar in this example, we're actually using it to buy the Japanese yen. This is same for this example with British pound against the US dollar. You need to also understand that the first currency that comes first in whichever pair you're trading is known as the base currency, which is on the left, and the other one is going to be the quote, which is on the right. So the idea is actually showing you is like how many currency of this you are actually going to buy in order to buy the quote currency. When you are trading one currency, like I said just now, you're actually selling the other one. So now talking about time frame. Time frame in forex trading can refer to a designated unit of time in which trading takes place. Typically, our time frame in trading usually is measured in minutes, hours, days, weeks, and months. You will have to choose a time frame that actually suits your trading strategy or the way you do your analysis. So let me go to the chart and actually show you guys what I mean by this. Now coming to the chart, the first thing you have to search for is tradingview.com. So basically what TradingView is for a retail trader is to be able to use it to analyze the chart. We actually don't use TradingView to trade, because we don't have enough capital or enough resources to be able to use TradingView brokers to trade. We actually use third-party brokers which are not very regulated and all. So in short, you are going to search for TradingView. Once you go to TradingView, you will go to the whichever pair you want to trade. So let's say you want to trade GBP USD. You will see that whichever pair you want to trade, they have different broker that can allow you to see the chart. Usually I use the Orlando or forex.com or FSCM. So you can choose whichever from one of these three to analyze your chart. So you have to click launch chart. So So once you click long chart, it's going to give you a different kind of interface. This is my own personal interface, but it can be changed. So once you change it, you can see that I can see the currency. So usually the currency that is at this top left is going to be the one you're trading, and you can see which broker is providing the service to you. So in this part top here, you can see that we can see which time frame we want. So let's say I want to trade the 5 minute. I can just favorite the 5 minute and click it. So basically what this means is that each and every candle you see here are being analyzed and being measured for 5 minute time frame, and if we go to the 15 minutes, it's going to be the same thing. So let me make this example again for you guys. This candle you see here is going to be a 15 minute, this is going to be a 15 minute, this is 15 minutes, and if we go to the 1 hour also, it's going to be the same. Each time frame you see here, each candlestick you see here, which is known as the Japanese candlestick, if you don't know this, is each time frame of whichever time frame we are on is the amount of time it's being closed or it's being traded. So you can see this time frame, the price, they drag the price up and down and up, and it's being closed for 1 hour. So you can see what is happening within each and every 1 hour candle, and it's the same for every other time frame. So that is it for time frame in short. Now talking about trading section. Forex trading section refers to the period of time during which the forex market is open. So the forex market is open from Monday to Friday, which is considered 24/5, and within that time, within the transit time, there's usually a slowdown in the market, and there are different sections that you need to consider in the forex market, which are 4. The first one is the Sydney section. The next one is the Tokyo section, and also the London section. There's also the New York section, which is the most volatile one. And for the Sydney and the Tokyo, it's usually recommended as the Asian section. So if you want to trade, you have to know what time fits the section in your own local time, so you can be able to trade at the right time. I'm going to say this again because it's very important. It's good that you know the time frame of the section that fits your own local time, so that you can be able to trade at the right time. And as you can see, every section actually overlap with each other. So as you can see here, this is the Sydney section. Within the time that the Sydney section want to close, it will overlap with the Tokyo section, and during the Tokyo section, within the time it will close, it will usually overlap with the London section. It's also same for the London section to the New York section. So now talking about lot size. So in forex trading, lot size refers to the amount of currency you are buying or selling in a trade. So there are 4 different types of lot size. There is standard, there's mini, micro, and nano lot. So each and every lot size actually has its own pips value and how to input them. In their unit form is going to be in this form, and in their volume form is going to be in this form. And in their pips value, you have to be able to calculate the pair you are trading. You have to be able to calculate how much it is in the pips value. So if let's say you are trading the major pairs, they are usually known to be $10, and if you are trading other currency, you have to basically go find out how much it is. But usually in general, we use $10 as the value of each pips movement. So now we go to pips calculation. In forex trading, a pips is the unit of measurement used to indicate the change in value between two currency. Pips actually stand for percentage in point or price interest point. The calculation of these pips depends on the currency pair being traded and the lot size of the trade. We use pip to measure the profit and our loss. So what this means is that the pair you are trading, you have to be able to calculate the pips properly, and also you have to know that the pips value are all different. So you have to make sure that when you're trading US dollar, to calculate the pips, the first decimal is actually not considered a movement, it's actually considered a movement in cent. So in cent, we start from the next movement point, and this is also same for Euro USD. Usually for major pair, they are all the same. If you are confusing what is major pair is actually pairs that are traded with the US dollar, which is considered the major currency pairs. So when you are calculating pips, you have to be very careful because when you're calculating pips in major pairs, it's very different from calculating pips in gold or in other currency pairs. You can see here for this example, when the gold moved from the first decimal, from the first movement, is actually considered a movement that not intense compared to the movement in the Euro USD. Now going to the next one, take profit and stop loss. This is a very important topic to know, especially for you guys that are new. Take profit is a predetermined price level at which a trader chooses to close a trade in order to realize profits. It's a price point at which a trader wants to exit the trade and lock in profit. For the stop loss is the other way. It's just a price point for you to know where you're going to incur loss or cut off your loss and realize a loss in that trade. And as you can see from this graph, when you have an entry, which you have to have an entry before you can basically have a take profit and stop loss. So when you have an entry in a trade, let's say you decide to sell on this trade, you can see that the entry is here. Where you decide to take profit is known as the take profit zone, which is also known as TP, and where if it goes against you, where it's going to take you out is known as the stop loss. So this is also the same thing, vice versa, for when you're buying. This zone here is the entry point, while this zone here is the stop loss, and here is the take profit, where you realize a profit and call it a winning trade or not. Now we go to Forex Broker. A Forex Broker is a firm that facilitates trade in foreign exchange market by executing buy and sell order on behalf of the client. So in this sense, we are the client. The Forex Broker are firms that help us to facilitate our trades to the market, to the liquidity provider. But this is not true in some cases, that there are different Forex Broker. Usually there's 3, but I'm just going to focus on 2 for you guys because these 2 are the most common one. The first one is the A book broker. The next one usually known as the B book broker. So what is the difference between these brokers? For A book brokers, usually they are able to send our order to the market, to the liquidity provider, which end up take our trade to the market and make sure that whatever we are doing is not being influenced by the broker. But the B book broker, usually they try to manipulate, they try to play with our order, they try to see if we are going to win or lose, and in other words, they are actually trading with us. They are not allowing us to trade with the market to be able to get the most best efficient trading we are supposed to get. So this is why I always advise any new beginners to make sure that you trade with a recommended broker. And if you check the description in this video, I have leave a link for a recommended broker that you can use to avoid being manipulated or anything while you're trading, while you're starting your journey. The next one is spread. In the forex market, the spread refers to the difference between the bid and the ask price. And essentially, it is the cost of placing a trade in a particular currency pair. You can read all of this, but I want to really go in depth with you guys for this because it's very important. As you can see, let's say you as a trader, when you're trying to buy from the market, usually, like I told you just now, we are going through a broker. So when you're buying, you're actually buying based on the bid price, and when you're selling, you're actually selling at the bid price. So here comes the idea from the broker. Usually, when you're buying from the broker wants to sell to you at an expensive price, which makes it higher cost for you. And when you're selling, the broker wants to sell it at a lower price, which make it at a very low price for you, which when the market moves to your direction, you actually already consider being in heavy loss. And as you can see from this spread calculation here, from this difference, when you are clicking an order entry, you're already losing 2 pips, and in some cases, some broker can actually even cost even 10 times of this price, which means you might be even just losing 20 or 50 pips by the time you are even entering just 1-2 trades. So in some sense, this can cost you a lot. It can even take off all your profit and make you realize that you did not realize profit at the end of the day. So this spread is something that you have to really pay attention to, especially when you're newbie. You have to understand that the broker you trade with is very important to know what is their spread. Are they providing a very lower cost of spread so that it can help you save money, it can help you make money once you enter a trade or you exit a trade. So this is a very important thing you have to know. There's always a bid and ask price, and this bid and ask price, the difference is what the broker is making, and if it's too much, it's actually going to be costing you too much. So this is why for we as a forex retail trader, we want to make sure we are looking for a broker that has tighter spread, so that it can allow us to have a lower cost when we are entering or existing a trade. Now we talk about leverage. In the forex market, there's something known as leverage, and leverage refers to the practice of borrowing funds to increase the size of a trade. It allows traders to control larger positions in the market with a smaller amount of capital, and leverage is typically measured as a ratio such as 1 to 50, 1 to 100, which indicates the amount of capital that a trader can control relative to their initial capital. So what leverage means, an example of it is that leverage is a form of way that you want to start a business, and let's say your business is going to cost you $1,000 and you only have $100. The brokers are able to provide us with leverage to able to make sure that we are able to get that $1,000 in order to take the same trade, even if we just have $100. But you have to know that leverage can be very good, and also it can be very bad if you don't know what you're doing or you don't know how to use it to your own advantage. It can result to an amount of significant loss for you, and it also can result to an amount of significant profit for you. You just have to know what you're doing and make sure that when you use it, you are using it the right way to realize more profit for you. So how to start trading forex? So when you want to start trading forex, first, like I said, you have to get a brokerage account to make sure that you can trade the market through the broker. Once you have a brokerage account, the next thing is to be able to log in the MetaTrader 4. So I'm going to show you now, bring you into how to download the MetaTrader 4 and how you can use the app and start trading. To get the MetaTrader 4 or 5, you have to make sure that you go to your Apple Store or you go to your Google Play Store in order to get your MT4 or MT5 to use it, to be able to use it to trade. So once you get there, you search for MT4. Now, as of 2025, we actually use MetaTrader 5. So once you see it there, you can download and you can open it. Once you access the MetaTrader 5, now you can see a lot of options from it compared to the MetaTrader 4, which is considered a bit more old school. So majority of the traders will use MetaTrader 5 now, so you can consider downloading MetaTrader 5 instead of MetaTrader 4 because of the advanced features and every other things you can use to make you be able to trade easily from your phone. So once you access it, in order to add your pair, you have to click here, and you can just click top here on this search. You can see which kind of pair you want to trade. Usually, let's say you trade forex, you can click here and you can add your Euro USD, GBP USD, USD card, USD JPY, USD card, USD AUD, and those ones I just had are known as the major pair I told you about, which are all the pairs that are being traded with the US dollar. So as you can see here, from 1, 2, 3, 4, 5, 6, they are known as the common major pair. So I'm going to take this one out to not convince you. So as you can see, these are all our major pairs. Once we have them, now you can just click and you can bring it to trade chart or the details of the pair. So now that we want to see the chart, or we want to basically analyze or whatever, we can go to the chart and it can bring it to us in a way that we can see, okay, this is the market we are going to trade. This is the current time frame of 15 minutes, which means every time frame here is actually 15 minutes. If you want to change this time frame, you just click and you can change to 1 hour, 4 hours, depending on the time frame that suits your trading strategy. So we can go to trade. It's going to show us the amount we have as a capital, and we can see the history, and we also can go to the setting to show us what is the account we are using. So in order for account, you have to click to do the account. You click settings, then you click here, then you click the plus. Usually when you sign up for the trading account, they are going to provide you the broker server. Then you can key in the broker servers. In this case, if it's, let's say it's just market, you can click in the server here and put in the server, and you can put in your account number. As long as you have been given the account, you're going to get the account number. Then you can put in the password. Make sure you save so that you can save there and you don't have to keep keying in the details. So I believe that is it for this how to trade. With this, you can already start to trade. Let's say now you want to open a trade. You can just click key and click chart. Once you click chart, you can be able to enter a trade. And with the features of the MetaTrader 5, you can just click the top right corner here and you can key in the amount of lot size you want to enter. For the lot size, I believe I take you through what is the lot size. So for this 0.01 is known as the mini lot. So you can just put that in and you can be able to know that, okay, I'm going to put in this amount of lot. Then let's say, for example, you can put it here. Then your stop loss, you can just drag and you take profit like this. Your stop loss, drag, then you take profit top here. So it's as simple as that for you to be able to see how much is your take profit, your buy limit, and all your stop loss and your entry and all. So the MetaTrader 5 is very advisable for you to download. So make sure you download and you can start using it to trade. So now let's go to the most important part, which is the type of traders. There are actually 4 different types of traders. There's scalper, there's day trader, there's swing traders, and position traders. So all of these traders, they actually accommodate with the time frame that they trade, and you as a newbie trader, you actually can choose which one you want to be in order to fit in your job or whatever lifestyle you want to accommodate with for trading. For me, I'm a day trader and I'm known to trade the 15, 30 minutes and the 1 hour time frame. You can trade the 1 hour and 4 hours time frame, which means it's going to take every 1 hour for the time frame to form, and you also can trade the 4 hours time frame, which means it's going to take every 4 hours. There's also position traders that they take 1 day and 1 week to be able to analyze their trade. You also can choose just one time frame to trade. They all fit on what strategy you are trading or how you feel convenient to the market. So in short, trade whatever is more comfortable for you and you feel you can be able to accommodate with your daily lifestyle. Lastly, I want you guys to know that congratulations, you can now consider yourself as a Forex trader, and Forex is known to be a money-making industry, but challenging. However, it allows you as a trader to take the chance to profit from the shift in the currency pairs. Like I told you, we're actually making the difference from 2 different currency pairs, and we are not just limited to trading currency pairs. We can also trade other commodities, indices, like we can trade US 30, which focus on stock through the Forex Brokers. We also can trade cryptocurrency like the Bitcoin, or we can trade the Ethereum. We also can trade gold. See, it's a dynamic space that gives easy way to start. It means you can easily start Forex now. You can start today. You don't have to postpone anymore if you have been considering to start. And also, Forex gives us a global reach. It means we can be able to trade from anywhere we are or anywhere we go, and it's available for trading through the brokers that give us the access to the market. And also, you have to understand that approaching Forex, you have to be able to learn. It's a consistent learning industry. It's not something that you learn now and you drop it for many years and believe you can come back. It's something that you have to put a dedication to, and also be able to be carefully trained. The approach towards trading is with a solid grasp of the market. It means you have to really pay attention to the market. You have to give it your time to learn. Don't quit your job now because you have found this. Make sure you start small, but having the plan to earn big. And at the end of the day, make sure you are starting to practice with demo or wherever in order to know how to understand some of the things that might not be explained to you in this video. But in general, I believe I have explained everything to you in this video. At the end of the day, you have to know that your approach towards the market has to be a continuous learning. After you watch the video, subscribe now so you can be able to watch my other video and learn about the Forex market, how you can be able to use it to make a living, or if you're someone like me, you want to use Forex to make a lot of money, to change your life, to change your nest egg life. You have to make sure that you engage with the knowledge I'm going to be providing in this video. So this is it for this video, and if you find any value in this video, please like, and subscribe. Send it to your friend that is trying to learn Forex. Make sure you share it with them, and you can basically go through it and learn anything you don't know through this video. So thank you. See you in my next video.